welcome back, traders and investors. It's Fundamental Talk Time with Anthony Alfidi. He is the founder and CEO of Alfidi Capital. Anthony, how you doing today?
I'm doing great this morning.
All right. Thanks for coming on the show here. And we talk a lot about technicals, and I know you're a fundamental investor. Before we go into talk about the fundamentals, do you pay any attention to technical analysis?
No, I don't. I was fascinated by technical analysis maybe 10 years ago as an interesting project to study, but then I realized there's very little academic research corroborating support for technical analysis as anything useful to generate alpha. So I'm very skeptical of anybody who claims that moving averages and candlesticks and whatnot can generate anything that's worth doing in a portfolio. I'm really interested in sticking to fundamentals of a stock.
I will say that fundamentals we know obviously take precedence over technicals all the time. You'll see an earnings report and somebody can say it's a beautiful chart setting up, all of a sudden, or you could say it's a bad chart setting up, and all of a sudden the company comes out with a good earnings report and the stock takes off. So we know technicals definitely take a backseat to fundamentals. So I will definitely give you that. So what fundamentals do you like to focus on there?
I deconstructed Warren Buffett's methodology. I use earnings, specifically Warren Buffett's calculation of owner earnings, to estimate whether earnings are consistent. I like high earnings quality, where a company is not playing games with funny accounting rules. I like to see a little bit of debt, not a whole lot, because debt has tax advantages, but a lot of debt, specifically debt that is more than twice what net income is for a given year, might indicate some problems later on if the economy runs into trouble and they can't generate sufficient earnings to meet their whatever debt covenants they might have.
So what's on your radar? Do you have any stocks that you are, look through this criterion, and do you have anything on your radar right now?
I've been watching a couple for a while that I really like, although the valuations are really high. I'm not prepared to enter yet. I'll give you a ticker. SFL stands for
Okay.
Ship Finance International Limited.
Yep.
It's an interesting company in the shipping sector. I think they're positioned to do really well because they've done a good job managing their costs and managing their debt levels for the past several years. The shipping sector is, I think, overpopulated by companies that have committed to too many new builds, too many new hulls, especially with the Panama Canal expansion. They built simply too many post-Panamax container ships and tanker ships that just are not going to be feasible given the collapse of the Baltic Dry Index this year. But Ship Finance International has managed themselves pretty well. So I think they'll be very interesting going forward. I liked for a long time a barge company called Kirby Corporation, ticker KEX. Their earnings have been really impressive. They've made quite a few private acquisitions. They're buying up other barge and tug operators on the riverine system of the U.S. I just like the fact that they have pretty much a monopoly lock on riverine transport in the U.S., except for the captive fleets of the captive barge fleets of the oil supermajors. They're a great company.
Okay, before we get into the individual metrics that you look at, being a fundamental investor, you can look at the fundamentals of the company. But sometimes, most of the time, you have to look at the fundamentals of the overall market and the environment that we're in. So, what's your overall analysis, the fundamental analysis of the market?
I like a metric called the Warren Buffett indicator. Warren Buffett referenced a couple times that he divides the market cap of the U.S. by gross national product to determine whether or not that there's some kind of macro level entry point for the market as a whole. The thing with that is he didn't give a baseline reference for it. So I looked up the OECD stats, Organization for Economic Cooperation and Development. They track those metrics for the major developed countries in the world. And you have to use that as some kind of reference to other countries and have to project it back. I won't say project it back. Yeah, you have to trace it back in some kind of historical timeline. So you can say, okay, is this indicator higher or lower than its historical norm? Is it better for the U.S. or worse for the U.S. compared to our competitors around the world?
So where does that, like right now, where is that indicator showing the market's at this 1925 level in the S&P? Where is that showing right now?
I haven't run the calculation in a couple months. I suspect that a lot of macroeconomic indicators for the U.S. are overvalued simply because the Federal Reserve has been pumping
Right.
monetary stimulus into the economy like crazy for the past several years. So any indicator you look at, anything at all, is going to be wildly inflated compared to where its historical baseline should be.
So when you're looking at the fundamentals, I know you like PE ratios here, but you have another ratio you look at called the quick ratio. Could you just explain that real quickly and perhaps apply it to a current stock of the market?
Yeah, I haven't looked at the quick ratio in a long time, to be perfectly honest with you. I just think I've been mostly out of the market for the past couple of years, with a couple of exceptions. So boy, I could look up on Investopedia
Okay.
a textbook definition of the quick ratio, but I just don't have it at hand. Sorry.
Okay, so you've been out of the market for the last couple of years, and that's just based on the criteria that you have for stocks or just not meeting that criteria?
Exactly.
Okay, so it's
So from a technical basis, we've been saying this is a little bit run too far. Now you're saying from a fundamental basis, you think this obviously the stock market is just maybe inflated with too much Fed stimulus.
Absolutely. And you don't have to take my word for it. Read some of the reports that have come out of the World Bank and the Bank for International Settlements. The BIS is the central bank of central bankers. They're in Switzerland. And they had a really interesting report in June of 2013. They came out and pretty much said that central bank stimulus, not just in the U.S., but Japan, Europe, China, everywhere, has inflated markets, equity markets, bond markets, real estate markets, all around the world, to the point where nothing makes sense. No valuation makes sense. And there were some really intriguing charts in that report. I recall the first couple of pages in that report showed the valuation metrics, stocks, bonds, real estate worldwide, going up and up and up, and the macroeconomic fundamentals, employment, GDP growth, and a couple other things, just going down. Market prices have diverged from fundamental economic drivers so greatly that even the central bank of central banks, the BIS, admits that we're in bubble phase all around the world.
Is there any markets anywhere in the world that are, more fairly valued here? Is there any other spots you're looking at here, like any other countries or any other markets?
Yes, I think there's potential in the natural resource sector, specifically the metal sector, gold. I think gold is undervalued. I think gold mining companies, especially in the junior resource sector, are the ones that survive, that can manage their exploration budgets really well, have an extraordinary chance to be positioned to outperform.
oh, that's
What
it.
it,
Go
is
ahead,
there any
Dennis.
specific miners that you're looking at specifically?
I looked at one called, the name escapes me. I'm thinking specifically of the ETF, ticker GDX. That
Okay.
tracks
Yeah,
the
which
gold
buys
mine
them all.
sector.
Yeah.
Yeah. I like GDX. I still have some GDX exposure because I want some kind of a hard asset hedge in case of a period of high inflation here in the U.S., which I think is definitely possible given the central bank's mismanagement of monetary policy. And the natural resource sector as a whole is a decent hedge against inflation anywhere.
Okay, so if you've been out of the market, you can't find worthwhile places to put your money. Are you making any attempts to short the market? I mean, if we're at this exaggerated phase in the market, are you positioned at all, or have a strategy to take place? To make money if the market goes down.
I'm not ready to short the market just yet, and I'm very wary of shorting anything, either an individual stock or an ETF that pays a dividend. Because, of course, if you're shorting something like that, you owe the dividend payment if you hold it through the X date through to your whatever counterparty you shorted it from. I am very intrigued by the possibility of a generational short in some consumer retail stocks, specifically hotel and travel, consumer electronics. I think those things that are very, very dependent on continued consumer spending and consumer indebtedness are very good candidates for short consideration.
I like that term, generational short. Do you have any
Yeah,
specific stocks you're looking at?
I'm thinking Apple, believe it or not. I
Oh,
really
I
wonder
like
if
this
Apple is,
guy. I
yeah,
like this guy.
I like this guy.
yeah, I really wonder if Apple's going to be able to sustain its sales. I mean, the iPhone's a great product. It's revolutionized the telecommunications industry, revolutionized consumer electronics all in one swoop, but it's a premium product. It's they can't compete on price. And every Android clone that comes out from Samsung or wherever drives another nail into the coffin of Apple's ability to sustain its market position in the smartphone market.
Okay, you were going to speak on the effects of news events, earning surprises, mergers, arbitrage, index changes. So, being a fundamental trader of those, news events, what's the one? Is the earning surprise is going to be the one that you place most emphasis on?
Actually, my favorite play of all those potential strategies is the merger arb. I've made quite a bit of money in the past few years off of merger arbitrage situations where if a merger is announced or an acquisition is announced, the classic move is to buy the target because the target's going to appreciate and sell short the acquirer. I've never sold short an acquirer, but I have made some options plays where I would buy puts against the acquirer and watch the puts appreciate in value, and also buy the target, the target of the acquisition, and sell some at the money covered calls over it if the options chain is still viable after the announcement. And there's some decent money to be made there. It's almost like the market leaves free money on the table for people who are quick enough to grab an M&A merger arbitrage opportunity.
Our firm actually, we were with Bright Trading there, and we had all our guys specialized in this back in 1999, 2000, 2001 in the risk arbitrage and the merger arbitrage, and they do exactly what you're saying as they looking to pick up those last couple of points. So we had one this morning here too. I'm not sure if you've heard already, but Covidien is being bought by Medtronic, MDT, and actually there is this is a relationship. This isn't a cash deal. It's 35.19 cash, 0.956 shares of MDT. So is this the type of play you'd be talking about?
Yeah, I'm not familiar with that deal specifically, but yeah, that's a very intriguing way to look at the play. Yes.
Okay, and then now with everything that's going on with the mega mergers and everything, you get people, a lot of talk that this is at the top of the market here. People or companies cannot find a way to get more value out of their company. So instead of being more creative with the R&D, they're going out and just doing acquisitions. You think that's symptomatic of a market top?
Yes, it's certainly symptomatic of a market top. I think the most compelling indicator of a market top right now is the fact that corporate earnings are something like 11 or 12% of GDP, and historically they've only been about 6% of GDP. So with earnings twice what they are, or twice what their historical average would indicate is a norm, is just remarkably indicative of an overvalued market. And if PE ratios, if investors are expecting PEs to continue to climb based on those lofty earnings, they're going to be in for a very sad surprise.
Okay, just to wrap things up here, you have a market environment. The S&P 500's pulled off its all-time highs. We're coming into a triple witch expiration, which generally creates more volatility. But that's all short-term stuff. I mean, what would your be advice to investors that have been in the markets for a long time and have built up those 401ks, RRAs? What would your advice for them be?
Okay. Well, just a caveat, I don't give advice because I'm no longer in
Okay.
possession of my security license. I'm not a registered investment advisor. I'm just an analyst, independent analyst, and I when I blog or publish analysis about my own stuff, it's about my own portfolio specifically, my own goals, my own
Okay.
risk tolerance, etc. But I will say this: for my own portfolio, I am very interested in generational shorts, like we said,
Mm-hmm.
and I'm very interested in hedging a potential collapse in the markets, stocks, bonds, real estate, and potential hyperinflation, seriously, hyperinflation here in the U.S. So what I've done is I've looked at hard asset hedges in the energy sector, the natural resource sector, the mining sector. I like a timber REIT, ticker RYN, called Rayonier. I think that one, once the valuation comes down a little bit, would be a very interesting play because people always need wood for pulp and such.
Right. Okay. All right. Anthony Alfidi, founder and CEO of Alfidi Capital, giving us a fundamental look at the market, which we always enjoy here on Benzinga's Pre-Market Prep. Brought to you by Options House. Anthony, thanks for coming on. Have a good day, and we hope to speak to you again soon.
It was my pleasure.